What's going on, everybody? Liam O'Reilly, Vermont economic realtor with Jerry Riley Real Estate. I hope you're doing well. Credit card debt hits an all-time high at $1.08 trillion, according to the Federal Reserve Bank of New York. And millennials are leading the charge with the most amount of credit card debt, the largest share of the increase in credit card debt. And in addition to that, credit card delinquencies are also on the rise, up significantly from a year earlier and up above pre-pandemic levels. So what does this all mean for you as a home buyer or a home seller in this market? I'm going to get right into that. But first, if you guys have any real estate needs, all of my contact information is in the description. Reach out to me directly. I'd love to hear from you. And leave me a comment. Let me know what you think about this video. Let me know where you think the housing market is headed. I love hearing from you folks. Let's get right into it. So this article right here out of Yahoo. Millennials are struggling with credit card debt. New York Fed study finds. So here's the headline story. Credit card balances rose by $48 billion in the third quarter, a record high of $1.08 trillion. So a lot of credit card debt. And then here we go. The same 90-day delinquency rate measure for credit card holders increased to 5.78%, up from 3.69% a year earlier. So there's more delinquencies on that credit card debt, and credit card debt is growing. People are struggling with inflation. It's a tough time right now to be a consumer in the overall economy. And then on top of that, student loan debt just got the student loan forgiveness ran out, so people have to repay their student loans and are struggling to pay their bills. So they're putting more money on credit card debt. Let's talk about that a little bit more, and then we'll get into how that affects the housing market. But we see this chart here going back to 2010. And that top line is the $1 trillion mark. So last quarter we crossed it. This quarter we're exceeding it, and credit card debt continues to grow. And the big thing here is that a lot of this credit card debt is driven by the millennials. It says right here in this first highlighted area, the sharp the sharp uptick in delinquencies was driven by millennials, those born between 1980 and 1994. So there's an overlap between millennials, auto loans, and student loan debt, like we just talked about. And then the thing is here, this next section I think is really key. Millennials have lower home ownership rates. They may be more exposed to increased rents, which may be putting pressure on their balance sheet in other ways. Boomers, on the other hand, have very high home ownership rates at this point. So in many ways, many of them have benefited from refinancing during the pandemic and would see some reduction to their household financial obligations, where renters won't see those benefits that may come from home ownership. All right, so let's talk about that really quickly. So basically what they're saying is they're speculating that part of the reason why millennials saw this increase in credit card debt compared to boomers is because they have a lot of payments that are changing, right? We talked about the student loan debt. They may have auto loans that are, increasing if they bought a new car recently, and then their rent is going up compared to homeowners, which may have their mortgage might be mostly paid off. I mean, my parents live in a 3-bedroom, 2-bath home on 2 acres in New Hampshire, and their mortgage payment, I'm fairly certain that their mortgage payment's under $1,000 a month, and that's because when they bought it, they bought it for a much cheaper price, and as inflation and home prices have risen, they've just kept their mortgage payment the same. They haven't refinanced, and they've kept things relatively stable. So it's tough to find a 1-bedroom apartment for $600 or $800 a month, or under $1,000 a month, at least up here in Burlington, Vermont. So renters, these millennials that are renting that aren't homeowners yet, are really struggling to pay their bills, and they're adding to this credit card delinquency, to this credit card debt. So how does that impact the housing market? Now, based on this data, where I think the biggest impact is going to be is to home buyers. And we are seeing that right now. If we head over to Redfin and take a look at the overall home buyer activity, we scroll up for their most recent market update here. Touring activity is down 22% from the start of the year. And then it's down 7% as of November 4th from a month earlier, Google Home searches. So there's less people looking for homes. There's less people out there touring homes with high interest rates, high prices, more credit card debt. there's just less buyers out there who are able to search for properties. And I think a big portion of those buyers are the people born between 1980 and 1994, the millennial demographic. So those millennials make up a big portion of the home buyer market, and so do baby boomers. But millennials don't make up a large portion of overall home owners, of the people in the home ownership, you know, of homeowners. So if millennials are struggling with their balance sheets, if they're increasing their credit card debt, they're likely renting. And so a solution for them to reduce their monthly expenses is not going to be to sell their home because they don't own a home. It's not going to be to downsize and move into something cheaper. For most of these people, most of the people, I believe most of the people struggling. Now, I did try to find some research to see the people with credit card debt, are most of them homeowners or are they renters? There's not really good data out there yet. But if somebody has a link for some good data that shows that the credit card delinquencies or credit card debt based on home ownership versus renting, I would love to see that data because what I think is going on based on the stats that we're looking at is most of the people that are struggling right now are renters. I'm sure there are home buyers struggling. There definitely are. But I think the majority of homeowners, the majority of people out there have a lot of equity in their home, have a lower monthly payment, have a low interest rate, and can afford to stay in their home and will try to stay in their home the best they can. Because if they're were to be foreclosed on, if they were to stop making their mortgage payment, then they'd be forced to rent a property that would be most likely more expensive or purchase a property that will definitely be more expensive in terms of price. Um, it will most likely be more expensive depending on when they bought, but in terms of interest rate, it will almost certainly be more expensive unless they bought within this past year, with interest rates at around 7.4%. It's very expensive to buy a home. So the point that I wanted to make about the US housing market is as we head back over to Redfin, I think this all comes down to active listings. We see that active listings have started to trend up throughout the course of the year here, but we're still seeing enough demand to swallow up new listings than to swallow up listings overall. That being said, we are entering into more of a balanced market. 3.6 month supply of homes on the market is entering into a balanced market. Roughly between 4 and 6 months supply is considered a balanced market. The month supply is a ratio between home buyers and home sellers. So I think the biggest thing that we're gonna have to look for, we're entering into a slow season here in the real estate market. The winter time, there's less listings. There's less buyers looking to purchase property in the winter. It's days are shorter, especially up here in Vermont. Um, but days are shorter. The weather's colder. We're in the middle of the school year. There's less people that are looking to move. Now, when we move into the spring market here, um, it's going to be really interesting to see what happens. And I think if we're gonna see prices start to come down, we're gonna start to notice that in the spring market because at that time there should be more listings. More people should be listing their home than they are right now. And while there should be more buyers out there as well, the lack of millennial buyers and the increased amount of credit card debt throughout the country might keep a lot of buyers on the sidelines this spring. So one of the things that I've been thinking through is how many buyers are on the sidelines and how many people, if rates were to come down a little bit, how many people are ready to jump into a home, or if home prices were to come down a little bit, how many people are there to buy it at that new lower price? And the answer is nobody really knows. Nobody knows that exact number of how many people want to buy but can't afford to right now. But when we see inventory start to tick up in the spring, as more new listings come to the market, as more people look to sell their homes, that is going to be the real test of how many people are out there on the sidelines looking to buy. Um, I'm sure, prices aren't just going to fall off a cliff right away. I've been talking on this channel for a while that I think something like the 1980s, where there's less home buyers and there's not many home sellers, and prices remain relatively flat for the next few years, is probably the most likely scenario. But if we were to see a decrease in home prices, we're going to see it in the spring when there's high credit card debt. There's less home buyers out there. There's less millennials out there looking to buy a home because they're struggling financially with their personal balance sheets because they're paying a lot in rent. And so when the spring market happens, when more listings come to the market, when there's more home sellers, if there's not more home buyers at the same time, then we're going to see inventory start to increase. I don't think we're going to see new listings skyrocket because a lot of people have locked into their low rate and they're not motivated to bring their home to the market. But we should see more listings. And if there's not more buyers out there in the spring than there are right now, I think we're going to see home prices start to come down. So that's what I'm going to be looking for is how does inventory react to the spring market? Are there more home buyers out there? Will there be more home buyers out there in the spring market? And if not, we'll see what happens to home prices. But anyway, I hope you guys got something out of this video. Liam O'Reilly, Vermont Economic Realtor. Thank you so much for watching. Leave a comment, and I'll see you guys in the next one.